Hello friends, in this video, we will learn about some basics of stock market. What is stock market? The stock market is a platform where you can buy and sell ownership units, shares or stocks, in publicly listed companies to build wealth over time. The Indian stock market is regulated by the Securities and Exchange Board of India, SEBI, to ensure fair practices and protect investors. Let's look at the various important components and key concepts associated with the stock market. Key concepts in stock market. Brokers, intermediaries, firms or individuals, who facilitate trades on your behalf for a commission or fee. You must use a SEBI-registered broker to invest. Demat account. A dematerialized account that holds your shares in electronic form, like a bank account for securities. Trading account. An account used to place the actual buy and sell orders in the market. It is linked to your Demat and bank accounts. Bull versus bear market. A bull market is characterized by rising stock prices and investor optimism, while a bear market involves falling prices and pessimism. Risk and diversification. Stock prices can be volatile. Diversification, spreading investments across different stocks or sectors, helps manage risk, so a poor performance in one area doesn't ruin your entire portfolio. Key concepts in stock market. Stocks, shares. A unit of ownership in a company. Owning shares makes you a part owner, potentially allowing you to profit from price appreciation, capital gains, and/or regular payouts from company earnings, dividends. Stock exchanges. Regulated marketplaces where shares are traded. India's two primary exchanges are the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. Indices. Benchmarks like the Sensex, BSE, and Nifty 50, NSE, track the performance of top companies and reflect the overall health of the market. Primary market. Where new shares are first issued to the public by companies, usually through an initial public offering, IPO, to raise capital. Secondary market. Where investors trade existing, already listed shares among themselves via brokers. Most daily trading occurs here. Key stock market participants. Retail investors, individual investors, institutional investors, mutual funds, hedge funds, etc. Market makers, provide liquidity. Factors affecting stock prices. The major factors affecting stock prices are 1. Economic factors. 2. Global factors, news and others. 3. Corporate and market-specific factors. Economic indicators. GDP growth, unemployment rates, and consumer spending reflect the overall health of the economy and influence investor confidence. Inflation and interest rates. High inflation can decrease consumer spending, while interest rate hikes can make borrowing more expensive for companies, negatively impacting both. Exchange rates. Fluctuations in currency exchange rates can affect the profitability of companies with international operations. Global events. International developments, including geopolitical tensions, global recessions, and trade disputes, have a significant impact on interconnected global markets. Foreign institutional investment, FII, flows. The entry or exit of large foreign investors can significantly influence market demand, supply, and price levels. Investor sentiment. Market psychology, driven by news, media coverage, and social media, can create positive or negative sentiment that influences trading behavior. Natural disasters. Events like floods or earthquakes can disrupt production and consumption, impacting company performance and investor confidence. Corporate earnings. A company's reported earnings are a primary driver of its stock price, as they indicate financial performance and future potential. Mergers and acquisitions. Events like mergers, acquisitions, or product launches can cause significant stock price fluctuations. Supply and demand. The most fundamental principle is that if more people want to buy a stock than sell it, the price goes up. Conversely, more sellers than buyers push prices down. Liquidity. The ease with which a stock can be bought or sold without affecting its price is influenced by trading volume. Low liquidity can lead to more volatility. Steps to start investing in stock market. Educate yourself. Understand basic terminology, market dynamics, supply, demand, and different investment strategies like fundamental analysis, evaluating a company's financials, and technical analysis, studying price trends. Define goals and risk appetite. Know why you are investing, e.g., retirement, a major purchase, and how much risk you are comfortable taking. This guides your investment choices. Open Demat and trading accounts. Choose a reliable, SEBI-registered broker and complete the EKYC. Know your customer process, which requires a PAN card, identity proof, address proof, and a bank account. Fund your account. Transfer money from your linked bank account to your trading account to be ready to place orders. Research and select stocks. Start with established, large companies, blue-chip stocks, and thoroughly research a company's performance, management, and future outlook before investing. Place your order. Use your broker's platform to place a buy order. You can use a market order, executed at the current best price, or a limit order, executed only at a specified price or better. Monitor your portfolio. Regularly review your investments and stay informed about market news and economic trends. Place a stop-loss order to limit potential losses on a position. Stock market trading and investments are subject to high risks. Consult your financial advisor before making investments. Investors must make their own investment decisions based on their investment objectives and financial position. Avoid being over-greedy. Quick money making is a myth. Investing versus trading. Investing focuses on long-term wealth accumulation. Trading focuses on short-term wealth creation and it's profit-driven. Investing is a strategy for gradual wealth creation over an extended period, typically years or decades. Objective: to build wealth steadily through capital appreciation, dividends, and the power of compounding. It's akin to a marathon. Time horizon: long-term, years to decades. Analysis: primarily uses fundamental analysis, which involves evaluating a company's financial health, management, and industry outlook to find strong, quality assets. Risk: generally lower than trading, as there is more time to recover from short-term market fluctuations and downturns. Involvement: requires less day-to-day involvement and monitoring, with periodic portfolio reviews being sufficient. Taxation: profits are typically subject to more favorable long-term capital gains tax rates. Trading involves the frequent buying and selling of financial assets to generate quick profits from short-term price movements. It's more like a sprint. Objective: to profit from short-term price swings and market volatility, often using leverage to amplify returns. Time horizon: short-term, minutes, hours, days, or weeks. Analysis: primarily uses technical analysis, which involves studying price charts, patterns, and market indicators to predict future price movements. Risk: higher due to market volatility, frequent decision-making, and the common use of leverage. The 90% rule in trading suggests that most amateur traders lose money. Involvement: requires constant, active monitoring of the market and quick decision-making. Taxation: profits are generally taxed at higher short-term capital gains tax rates, which are often the same as regular income tax rates. Risks and rewards. In stock market investing, there is a direct relationship between risk and reward. Investments with higher potential returns typically carry a greater risk of loss, while safer investments generally offer lower returns. The key for investors is to find a balance that aligns with their financial goals and personal risk tolerance. General tips for beginners. Stock market investing for beginners requires a focus on education, risk management, diversification, and a long-term perspective. Key tips include setting clear goals, only investing money you can afford to lose, and choosing reliable companies with strong fundamentals. Conclusion: investing and trading in stock market, shares, securities markets are subject to market risks. Read all the related documents carefully, consult your financial advisor before making investments. Investors must make their own investment decisions based on their investment objectives and financial position. Thanks for watching. Telegram channel: t.me/trendsandtiming, www.instagram.com/trends_and_timing.